Hello everyone, welcome back to the channel. If you've ever looked at a company's financial statements and wondered, is this business actually making money? Then today's video is for you. In this video, we're breaking down one of the most important financial statements in accounting, the income statement. I'll explain what it is, what it shows, its main components, and why it matters so much in business and financial decision-making. By the end of this video, you'll be able to read an income statement with confidence. So let's get started. What is the income statement? The income statement, also known as the profit and loss statement, shows a company's financial performance over a specific period of time, such as a month, a quarter, or a year. Unlike the balance sheet, which shows what a business owns and owes at a single point in time, the income statement answers one simple but powerful question. Did the business make a profit or a loss during this period? It does this by summarizing revenue earned, expenses incurred, and the resulting profit or loss. In short, the income statement tells the story of a company's operations. Structure of the income statement. The income statement follows a logical flow, moving from the top to the bottom. The basic structure looks like this: revenue, expenses, profit or loss. You'll often hear this described as revenue minus expenses equals net income. This simple formula is the foundation of the income statement. Now let's break down each part in detail. Revenue. Revenue is the income earned from a company's primary business activities. For example, a retail store earns revenue from selling goods. A consulting firm earns revenue from providing services. A transport company earns revenue from moving passengers or goods. Revenue is usually shown at the top of the income statement, which is why it's often called the top line. It's important to note, revenue is recorded when it is earned, not necessarily when cash is received. This follows the accrual basis of accounting. High revenue is good, but revenue alone does not mean a business is profitable. That's where expenses come in. Expenses. Expenses are the costs incurred to generate revenue. Common examples include cost of goods sold, salaries and wages, rent, utilities, marketing and advertising, depreciation. Expenses are usually grouped into categories. Cost of goods sold. This represents the direct costs of producing goods or services sold. When you subtract cost of goods sold from revenue, you get gross profit. Operating expenses. These are day-to-day business costs, such as office rent, administrative salaries, insurance, electricity. When operating expenses are deducted from gross profit, you get operating profit. Expenses reduce profit, but they are necessary to keep the business running. Profit levels on the income statement. An income statement doesn't show just one profit figure. It shows multiple levels of profit, each telling a different story. Gross profit. This shows how efficiently a company produces or sells its products. Operating profit. This reflects profit from core business operations before interest and taxes. Net profit, net income. This is the final figure at the bottom of the statement, often called the bottom line. Net profit shows what remains after all expenses, including interest and taxes, have been deducted. If expenses are greater than revenue, the result is a net loss. Why the income statement is important. The income statement is important to many users. Business owners use it to assess performance and plan for the future. Investors use it to evaluate profitability and growth potential. Lenders use it to judge whether a company can repay loans. Management uses it to control costs and improve efficiency. It also helps in comparing performance over different periods, comparing one company with another, making strategic business decisions. Without an income statement, it's impossible to truly know how well a business is performing. Key concept to remember. The most important thing to remember is this: the income statement measures performance, not cash. A company can be profitable on paper and still struggle with cash flow. That's why the income statement should always be analyzed alongside other financial statements. Conclusion. To summarize, the income statement shows a company's financial performance over a period. It starts with revenue, subtracts expenses, and ends with net profit or loss. It is a vital tool for decision-making in accounting and business. If you found this explanation helpful, don't forget to like the video, subscribe to the channel, and share it with anyone studying accounting. Thanks for watching, and I'll see you in the next video.